Good evening, traders. I am Devang Mehra from the Financial Analyst, and this is the Bold Project. In this module, we'll discuss about targets, stop losses, and trailing stop losses. Also, we'll discuss about the risk-reward ratios. In the previous modules, we have discussed with you support and resistance trading. So it becomes very essential for you to know what should be the targets and what should be the SLs. I want to make one point clear. This is the way most of the traders use and should use how to set target and SL. But in the course of time, we have discussed many strategies and many other trading setups. So in those trading setups, we have individually given what should be the SLs and targets. So if you do not know what the SL target should be, use this video. For the other strategies, it will be discussed in that video itself. So let's start the concept. We'll use the same example. We are looking at the charts of Tata Consultancy Services. You can have a look at what the resistance should be. Take a look at the chart. It's very clear that 2250 levels should be a resistance zone. At the same time, if you look at the support, you can see a very good demand zone at 2050 levels. This should be your demand zone. Having that established, now the question is how to take a trade on it and what should be the risk, SL, etc. First of all, I want to make one thing very clear. When you take a trade, you have to answer some set of questions without which your trading will not make sense, without which you are poised to lose money in the market. The first question is, when you decide what stock to trade, what is the objective for you? Do you want, for example, I want to trade TCS. Is my objective to trade in TCS for long term? Is my objective to trade for short term, 1, 3, 4, 5 weeks? Or is my objective to trade in TCS for intraday trading, that is to buy and sell within the same day? You have to answer that question, number one, because you have to, if you have seen the previous videos, answering this question will lead to you deciding what time frame do you have to open to trade the chart. Number one. Number two, once you answer this question, you always need to know what is your target, what is your SL, and what is your risk reward. Why do majority of the retail traders fail? Why do majority of retail traders lose money in the market? It's very, very simple, guys, because of this emotional concept that they have. Our human psychology tells us to do one thing. If you see anything in profit, for example, you take a trade in TCS, and the next day, today you took a trade, and tomorrow you see 1% TCS is higher, your normal human tendency will tell you to book the profit. Why? Because you have earned some money in one day. You have earned about, let's say, 500 rupees in one day, and you'll book the profit. Whereas, if you are a good trader, you will actually hold on to those profits and let them running. But what our human psychology tells us to do is, if you see something in profit, whether it is small or big, immediately book it. If you see something in loss, what do? We don't book it then. We let it run. That's the biggest mistake retail traders do. For example, if TCS goes in, if you buy TCS, let's say at 2050 levels, and it goes down, we do not sell. We keep on holding, just to realize 4 or 5 months later, it's been a very, very big loss. So always remember this concept. Let your profits run and let your losses cut it out. Cut your losses fast and let the profits keep on running. I want you to follow that approach. That's a human psychology. I want you to embed it in your minds when you are trading. If you see something in red, if you think that's not a good entry you trade, do not hold on to it. Let it get out of it and find another better entry and hold it for as long as possible, whatever time frame you are trading. Number two, when you decide what time frame to trade, when you decide which stock to trade, you need to decide the targets and you need to decide the stop loss. If you are not deciding a target, what you are basically doing is you are just sitting in the market and letting God decide whether you want to make money or not. That's not the case. You need to be very disciplined in your approach. You need to come into the market and say, okay, if I'm buying at 2050, my strict target is 2250. That's all. If it goes above that, no worries. I am okay with it. I will book my profits here. If it does not reach here, I will wait for the profit to be triggered, but I will not sell it here. So understand one thing, in the market, someone will always earn more than you. Don't get disheartened. You have to make your own money. Whether it is a small amount or it's a big amount, you have to be very disciplined in your approach. Coming to the same example, you talk to yourself and say, I'll buy at 2050, but I will sell it once it comes to 2250. I will not hold it above that. I will not sell it below that. So what am I doing? I am becoming very disciplined in my approach. At the same time, you talk to yourself that if the price goes below 222050, I will immediately sell. My stop loss gets triggered. So what I'm trying to tell you is we are trying to be more disciplined in this approach rather than being just some, fish in the sea. We are being very disciplined and motivated when it comes to trading. So first of all, let's talk about the targets. I have drawn my demand and supply zones. It is on the screen for you guys, 2050 and 2250. I can see multiple levels of resistance being tested and multiple levels of support being tested. So the levels are looking good to me. A very, very good tool is over here, which is called the long and short tool. Go over to the 6th or 7th option, click on the side arrow, and you can see this long and short position. Long basically means you are buying and short basically means you are selling. So let's take an entry. Let's basically decide what should we do in the market. So if you remember the candlesticks in the last module, we have told you all to combine the candlestick concept and the price action concept. So you can see very well over here, the area I have encircled, there is a doji. So you have a support, and at that support, there is a doji telling you, I'm not going to go down. From this point on, I am going to go up. That's a buy entry for you. When do you take a buy trade? We only take a buy trade if that doji highs are broken. This should be clear in the candlestick module. So what's the confirmation number one? The confirmation number one is that we are at support. Confirmation number two is that we are coming to at support and giving a doji. That's a halt kind of candle. And the confirmation three is that the highs of the dojis are broken. This means that market wants to bounce here and go higher. So when do I take a trade? On this green colored candle, I want to take a trade. So put out that tool. Are you buying or selling? So we are going long. Click on the long option and click on that green candle where you want to take a trade. Once I click on that green candle, a tool like this is going to open up. The green side is the profit and the red side is the stop loss. Understand something. What is a stop loss? A lot of people have heard about it, but they don't know how to trade the stop loss. What is a stop loss exactly? So stop loss basically is an area on the chart. If it gets triggered, it means your trade idea has gone wrong. It has got invalidated. Very, very simple example. 100 is a level of support. You want to buy at 100 and you are expecting from 100 the price will shoot higher. So you buy at 100, but at the same time, you know very well in your heart that if you go below 100, let's say 98, that's an area, if you come there, it's going to plunge down further. So the 98 becomes a stop loss. It means that if you rise from 100, good enough, you have made money. But if you go below 100 to 98, it means your trade idea got invalidated. It has got useless. So always remember, as I discussed, we are betting against the multi-billion-dollar hedge funds and the brokers. So there will be losses. There will be stop losses. So you have to define at what point of time am I going to accept that I have gone wrong in the market. So basically stop loss is that time when you are accepting that I have gone wrong in the market. So coming back to the same example, I am going to go long on this green candle because I have taken support and I am bouncing from this doji. Click on that long position, click on that green candle. What should be my profit? This green area is called my profit. My profit, my target basically should it be here? Let me ask you something. Should it be above the resistance? Ask yourself, take a minute. No, it cannot be. Why? Because resistance is a ceiling. You are not expected to go higher. You are expected to hit that and fall down. So my target can never go above resistance. Price goes above, that's not my concern. Let the price go above resistance. But our target logically has to be not above resistance, not at the resistance. If you remember the last video, we talked about emotions like fear and greed. So we will never keep a target above. We will never keep a target at. We will always keep a target just below the resistance. So my target is about 136 rupees from that point of entry. Now the question is, what should be the stop loss? Should the stop loss be very small over here? Does not make sense. You will get stopped out. What should be the stop loss? Think about it. This is the support. You are getting a doji over here. So you should bounce here. The stop loss should be, what is the area where trade goes wrong? The area where trade goes wrong is if the price goes below the support. So in this same example, if my price goes below the support in this area, my trade goes wrong. So that is how I have to place my target, and that is how I have to place my stop loss. Target always comes below the resistance, and the stop loss will always come below the support. It cannot come here because it will get triggered and you will lose out. Do not just for the sake of it put a small stop loss. You will always get hunted. Markets will always find a way to hit that stop loss. You always have to put your stop loss below the support so you have a cushion and it is not triggered. At the same time, I come to the third concept of risk reward. This tool is very, very helpful in deciding what should be the risk reward in trading. Risk reward basically means you can see the ratio 2:1. What does that mean? This basically means how much reward do you want, and at the same time, how much risk are you expecting? So for example, I want 100 rupees profit. At the same time, I only want a 50 rupees risk in front of that. I hope that point is becoming clear. So in this example, you want a 136 rupees profit, but only you want a 67 rupee loss. So that means you want 2 rupees profit per unit of loss. That is a good ratio. So always when you enter a trade, you need to be comfortable with risk reward. My simple idea is never enter a trade which is less than 1:1. So for example, if I take this, if let's say I take a trade over here, I miss this entry. I want to chase the markets and I take a trade over here. Is it a good trade? Let me ask you. What is the target? Target will remain the same over here. It can't go higher. Just because you're taking a trade higher doesn't mean you'll put the target higher. Targets will still remain below resistance. What's the stop loss? Can I put my stop loss here just to manage my risk reward? I can't do that. I'm very sorry, but I can't do that because I will again, markets will try to come down to support. Support is a floor. Market is going to come to support. You will get something that we call rubber band snap. So if you have a rubber band, if you extend it too much, it is again going to come here and snap. The same is the case here. This is a rubber band. You are extending it too much. It will come down at one point of time to snap back at a support. So I can never place my stop here. My stop will only come here. It will remain the same. So I have to do that. I have to do logical trading, not just for my risk reward. Risk reward has to be logical. So now what is the risk reward? You only want 64 rupees of profit. At the same time, you want to accept a loss of 140 rupees. So you are going for a 0.40 trade, is to 1 trade. You are going for 0.40 rupees profit, but for that 0.40 rupees profit, you are going for a 1 rupee loss. Are you happy with that? That is basically poor trading, poor risk management on your side. That will not make sense. I hope this concept of targets, stop loss, and risk reward ratio is clear. My main idea would be always go in for trades which are much more than 1:1. 1:1 should be the minimum criteria. Never go below 1:1. Good trades can be 1.5:1, 2:1, and 3:1. Then if you get the momentum in the market, that's up to you. But never go for a trade below 1:1. I will show you a trade on the short side as well. So let's say you are an intraday trader or you are trading in derivatives and you want to take a short entry on the stocks. So let's find a short entry. So for example, you can see something we call a dark cloud cover over here. That's an advanced candlestick pattern. Somewhere over here, you can see a dark cloud cover is being formed. So that means that at a resistance, you are getting a candlestick entry to say sell. That's a trigger to go sell. So number one trigger is your resistance. Number two trigger is your candlestick. So we are getting sell. So click on that short position now. I click on that short position. When do I go short? Below this red candle. That's where I go short. What will be my target? Can my target be below support? It cannot be because price is expected to always bounce back from support. So targets will never be below, never be here. Now it will be above support. I hope you are able to distinguish between both of the buying and the selling side. So if I'm going short on the stock, this means I want to earn money if the market is going down. So if the market goes down, I make money. So what is the target? My target becomes above support now because support is the area where you'll bounce back. What is the stop loss? Can it be below resistance? No. Now the SL will become above resistance. The way I put it is Basically above the highs, I like to put the stop loss. What is the risk reward? The risk reward is coming to a 3.6:1. Amazing trade. I think it cannot get better than that. These are the ratios I want you traders to maintain. Another question people ask me is, let's say I miss this entry, can I take a trade in the middle somewhere? Let's find out from this risk reward tool. I want to, let's say, go short on this big candle. I want to chase the markets. So will the stop loss be a little bit higher? No, it can't be. The stop loss will remain the same above the candles, above the resistance. Will the target change? No, just because you took a late entry doesn't mean you'll change the targets. The target will still be here. What is the risk reward? The risk reward is 1:1. So it is still fine. You can take that trade, because for every unit of profit, you are there to accept 1 unit of risk as well. I hope these points are clear. The risk reward ratio, the targets, and the stop loss. So this, what I have discussed, is for a range bound market. So if the market is moving between support and resistance, this is how you have to plan your trades out. This is how the risk reward SLs and profits have to be. So this is only applying to a range bound market. For any other breakout and other strategies, we will be discussing them in the respective modules. I hope this concept is clear. I will see you in the next part, where I will show more examples to you guys. And I hope then the concept of risk reward, stop loss, and targets are clear. Thank you so much.